Morning, everyone. Loud, loud, loud. Um, Try to get that volume fixed. Welcome again to another session. Today we have Mr. Aaron Haffner from Priority Home Lending to talk about new rules, new updates, new things for loans in 2026. Also, what the new loan limits are, and just going over some great, just general information that you guys need to know. So let me go ahead and share screen, and then I'll hand things over to Mr. Aaron. When you're doing.
What's the other one? I think it's the.
Oh, is that this one?
Been.
Okay. That one? Oh, this one.
Yeah, yeah, yeah.
Oh, if you're in full view, it won't let you share it. Let me try.
There you go. Second. I like.
Yeah.
Have you? Yeah, because it's one of the units, manager broker in Seattle. It has that listing. So I was down there. It's, it's decent. It's decent. The Terrence was another unit like that in the land. We'll go through a look at it. Well, I'll go through it.
It's all. No. Somebody met.
so typically what you do is from a lender perspective, we look at we take out, we deduct the meals and entertainment from the income. Okay? And so then you have your net profit loss. So you have your obviously sales, you put in your expenses, your net profit loss, you write a bunch of stuff off, and then your bottom line number, the bottom line number is used as the income. Okay? So we, whatever you put down here, we take that number, we use it, and we actually subtract it out. So if you said you made like 100 grand, you write off 50 grand, essentially then we use $50,000 as your income. Okay? And so that's how we use it on that's what we would use. Whatever you report on the tax return, we use as income for that. And so yeah. Then so so what we do is the average the income. So if you've been self-employed for more than 5 years, then we look at a 1-year tax return. If you've been in self-employed for less than 5 years, you typically need to use a 2-year tax. So the average. So if you wrote back here, so if you said, look, in year 2 I made 50,000, and in year 1 I made 100,000, it's showing it's going down, right? That becomes an issue because it's declining income. But the opposite is true. So if you had year one you had 100,000, in year 2 you made 200,000, well, average, the 100 and 200. So that's typically how we look at those tax returns. Okay? And so again, it's kind of tough because you want to write a bunch of stuff off, but we have to use that as income. And that's typically how it's done 99% of the time. I've been in business for 100 years. This is how we've always been doing it. But these loans are what we consider qualified mortgages. And so a QM loan has the ability to repay. There's no interest-only payments, there's no negative amortization. They have a safe debt-to-income ratio, typically around 43%, but you can go higher. Fully documented, they use pay stubs, W-2s, tax. That's a qualified mortgage. That's what a loan typically is 90% of the time. Qualified mortgage, QM. And examples are conventional, FHA, VA, USA. These are all qualified mortgages. But then the problem is that as an entrepreneurial borrower, right, they are different kinds of income. Important to IRS. Talk about that. And then here's the actual. I instead of make $30,000, but now make more. So again, if that's how we see it, and that's how the entrepreneurial borrowers look at that, then what do we do? I mean, we're missing out on a lot of people who make good money that we can't do these loans for if we use flat. So what we do is we can look at a QM non-QM. And so examples of it. So it says non-QM loans still require underwriting. They're not subprime loans, right? So we're not doing some crazy things that we do back in the day. It simply allows people's non-traditional income or unique sphere of quality. And so examples are self-employed with strong cash flow but low tax income. Gig workers, commission-based borrowers, real estate investors, buyers with recent major credit events, and high net worth individuals with high asset. Got a ton of dough, but I don't make a lot of money. That should be good enough, right? I got enough to cover mortgage, right? So those are qualified mortgages, right, or non-QM loans. And these are becoming more and more popular as more people become more entrepreneurial, right? That's kind of what we do. So these are becoming, I would say for these, like 3 to 4% of the market. Now they're going to be 20 to 25, maybe 30% of the market. And we'll have a lot of clients who don't fit or in this box, right? And they're like, hey, I don't traditionally do this, but there's a need for this, right? And so again, we're still documenting everything, but it's just in a different way. So what traditional banks want to see is this: right down the middle, fairway, hit the green, perfect. And then typically this is kind of what we see. This is kind of what, yeah, trying to be funny. So, so, so what we've got different ways of documenting. So we have a primarily a self-employed products. We have a suite of products for actually self-employed borrowers. So we have bank statement loans where you can use personal and business bank statements to show the deposits coming in and using that as income. Okay. We also you can use profit and loss loans. So we look at the profit and loss statement, current profit and loss. We can use that as income. The other thing is we can use 1099 statement loans. We got that. We can also do traditional agency loans over the old tax that we talked about before, right? So if you can qualify doing a regular and it's fine, then we can use that. But these are these three other ones that a lot of people don't know about, and these are becoming more popular, especially with some. So there are ways. Bank statements. Well, profit and loss you only need one. And you can create, and I'll go through that in a little more detail, but that's it. You can do, say that you can do profit and loss statements. It has to be set up by the CPA. Okay? But we can use those. We can look at the, like I said, the bank statements coming in, the money going in and out, or your 1099. We can use those. But these are like some really good ones that might not fit a lot of box. You might know a lot of folks who who are self and like, hey, I can never get a loan. Giving up looking. Well, maybe there's a way that we can fit them in a box. So So typically what we use with the regular qualified mortgage is your net income, right? So they take out deductions and everything else versus just using the gross income that you have. So that's the major difference between qualified a non-qualified QM over here. That's the difference. So we try to use the gross income, which creates more income. So here's an example of profit loss. You can use a CP letter for the income. Okay. So under this program, it says your bar requests a 12 to 24 month P&L from their CPA. They can request that. It does not have to be audited. It can be the borrower cannot prepare it itself. You get the CPA to create a profit loss statement. The borrower requests how long the borrower has been self-employed, confirmation that the CPA filed the borrower's last tax return. They want to see that the borrower doesn't file their own tax returns. They use a CPA and it's for the same CPA that did the loan last year. Okay, so they want to kind of see these things. Okay, and they want to know the borrower's business ownership, and they attest that they're not related to the borrower or associated with. So that's what you do. You just ask the CPA to create this letter for us. And so, and then sometimes if we can go with a bank statement loan, so we can look at the bank statements being deposited, but sometimes people may have a non-sufficient draw on their account, right? Or the borrower owns multiple businesses, multiple bank accounts, or the bank accounts don't show consistent or regular deposits. So we've got like a suite of products, so then we can look at it and say, look, send me your stuff. Let's take a look and see what fits, right? And so sometimes you can use the bank statement, other times we can use the profit and loss, which is pretty cool. And then when is profit loss not an option, when the borrower is not using licensed tax preparers or they do their own tax returns, stuff. So again, we could look at profit loss, we could look at bank statement. And this is probably one of the easiest ones you can do. So one of the questions we can ask the borrower is, what percentage of the business do you own? If you own more than 25 to 50%, then you're okay. Most of them just own it outright, right? And then do they have a licensed tax professional who files the taxes? Yeah, I do. Okay, great. Did the licensed professional file the most recent tax return? Yeah, he did. That kind of thing. And how long have they been self-employed, right? So a lot of these still require a 2-year history of being self-employed. Okay? I do have some investors that will go to 1% or 1 year, but again, and the interest rates change a little bit too based upon rent and other things. But so yeah, and then the borrower they have to require to put together a business narrative. What's my business doing? How long have I been in business? That kind of thing. But we can look at those, and so it's not clear. Sorry, but anyhow, you get the CPA to do all the work. That's the best part. So you provide the borrower with the requirements for the P&L letter. Be sure to set the timing and expectations. So if you're trying to get someone trying to do this program, and now I think the CPA is going to be probably pretty busy, right? So set the expectation. Borrower should contact the tax professional and request the P&L in the letter and review it with the CPA letter to ensure it covers the investor requirements to avoid delays. So every investor that we have many different places to put it. Sometimes they have different things. Each one's slightly different. But obviously we try to find the one with the lowest best rate. And then we kind of go to if they fit in that box. But basically what it's telling you here on this is that it just says they own 100% of the business. It shows what the net profits were. It operates the expense ratio. I'll explain that in a second. It's in good standing, and that the borrower can take money out of the business if they want to, with the bank statement, stuff like that. If they want. Okay? Nothing super crazy. So I think that's pretty cool. And the way that it'll work could be something like this: is that you perform a 12-month average of the calculation of the net income from the profit loss, right? So down here, they've got the net income down here, right? And then we just divide it by 12. And in this case, they multiply it times 50% because they're 50% ownership. So then we just use that income, right? So then in this case, if they own half the business, we get $9,500 that we can use on a profit loss. I'm not using a tax return that was from last year that shows they didn't make any money, right? So sometimes don't even need the tax returns. We just need the profit loss. So they'll work it that way. Okay. But that's how we create this income. We're looking at that stuff. We're looking at the before taxes and everything else. So again, this is all done by the CPA. They can do what they need to on it, right? Sure. We said, look, they kind of know what the income is going to be. Maybe the expenses aren't nearly as much as they were last year and everything else. And sometimes we can add in the place depreciation and amortization back into the income with the investors. Just a real raw example of kind of how this works, right? So I think it's pretty cool. And as these become more common, again, we're not trying to get a tax return. We just get the CPA to write a letter for us to get the profit loss, right? So, and then we can use that as income. So the takeaway on this is that profit loss pricing is fine with bank statement pricing loan. You can go up to maybe 85%, meaning 15% down. You have to own at least 25% of the business, and we want to be mindful of when considering the program because taxes next time. So taxes are due in April, and the business taxes are due in October. So both of those times will be kind of in. And then you can also go up to 6% seller concession. So I'm buying a house, and hey, I got a ton of money from the seller. Hey, I can use that. Go up to 6%. That's seller credit. Does that make sense? And then the other one. So then I was going to talk about the bank statement, the 1099 statement. Okay. So a 1099, if you're a commission or independent contractor, that's when you get a 1099. Sound familiar? So again, a 1099, you get that at the end of the year, and then you pay your own taxes on top. Okay? So then when the minimum to your self-employment history is a 1099 receipt, but I might be able to have an investment I might do 1 year. Okay? Typically, one of the following is used to determine the expense factor. Use 10% of expenses or provide a third-party profit loss to determine the expense factor. So basically, what we do is take 10% off the profit loss, or if you're a 1099, and we can use that as income. Okay? You calculate 12 or 24-month average for the total of the 1099s minus the expense factor from the method chosen above. And the year-to-date must be documented when 1099 is 90 to 120 days of the note date. So we wanted to make sure that you got income, right? So again, if beginning of the year might be slower for you guys. So if we buy it and we do within 120 days, don't need to get one. So we can still use the end of the year one for that. Those are kind of because normally you might write off a ton more stuff than 10%, right? So that's kind of the beauty of it. We're trying to use more of the what's realistic, right? As opposed to trying to write everything off, try to get minimal dollar, you have to pay tax. So you work hard for your money. You totally understand why we write it off. But that's one way of doing it, right? Which is pretty cool. The other one is bank statement loans with personal and business. So we don't need tax on these. This is for personal bank statements. So if I have a Schedule C and I just put everything in my personal account, I need to have 20 to 25% ownership. So look at 12 to 24 months personal statement. And then you have to have a minimum of 2 years. Typically, I might have an investor that goes for 1, but typically you'll see most of this with a better rate in terms of 2 years. Provide evidence of the ownership, no tax return, no transcripts, no expense factor. You're going to look at that, right? So the income is the sum of the acceptable deposits and the number of bank statements for the income. If there's no business bank account, you can also do one with commingled as well. And if it's personally account is jointly owned, the joint owner is not the owner of the business, deposits are not readily identified, must be excluded. So if I have 2 people, right, on the loan, one person's on the loan, one person's not, the other person's an owner of the business, the other one's not, then we have to take out their deposits because it's not part of the business. But the beauty I like is you take the deposits, there's no tax returns, no tax transfers, no expense factor. You just add it up and divide by the number of things. So, which is pretty cool, right? Pretty neat. And if you have business income, so if it's have everything in a business account, you gotta own the minimum 25% ownership. It's the same thing, 12 to 24 months. Provide ownership percentage, no tax returns, no tax transfers. Standard expense ratio of 50%, CPA or P&L provided to grow lower expense ratio. Sometimes if it's all in the business, they might take 50% versus personal. Okay? So you take the total deposits times the expense ratio and the percent of the ownership and use that as income. Okay. So I do have other investors that do 10% and 15%. They give you more, but the rate's going to be higher, right? So that's kind of the trade-off. So in other words, we look at the pool and figure out what's the lowest rate possible. Great, here we go. But can they do this work and that kind of thing? So again, there's different ways that we can look at it rather than the traditional way, which is just like, hey, I showed a negative $30,000 loss by tax return. Sorry, can't help you. But I have a bunch of deposits coming in. I write a bunch of stuff off. That kind of thing. Right? So again, I'm not expecting you to know all these, but all I just want you to know is that hey, there are ways than just doing traditional, because we all have. I'm sure you know a ton of folks that are, hey, I'm self-employed, no way I can buy a house, government sucks, they take all, just all this stuff. I totally agree, but there's different ways that you can do this. So again, we have bank statement loans, we have 1099 loans, we have profit loss and whatever kind of detail profit loss loans and traditional agency law. Just a lot of stuff. I mean, again, this is becoming more and more common, and we have ways to kind of go around it and look at that. So that's kind of the takeaway, which I think is pretty cool. So takeaways: creative finances for self-employed borrowers. Many investors that cater to self-employed borrowers. Investors are the people that we have that we can use to get more deals that you think may not happen or create more of an opportunity. See, the thing is, a lot of these people who want to get these kinds of loans, yeah, they're rate sensitive to a certain extent. They just want to get a house, right? And so the difference between traditional QM mortgage and a non-QM, I would say if the interest rate is like say 6.125, these might be 6.5. But it's not crazy. You're not paying 10%, 10%. Now, if you want to do some of them that have 1 year and have the expense factor of only 10%, then maybe you are looking at 7 or 8, whatever. But at least they get in where they didn't have an opportunity before. So, but a lot of these aren't crazy on top of what the current rates are. So they're not terrible, right? So it's not like you're paying you're going 3 points, you're paying 10% when the going rate is 6.25 or 6. I'm just kind of short, sweet today, but it's a lot of technical stuff, but you don't need to know the technicalities. If you have someone who thinks you're self-employed, thinks they can't do it, send it to me. I'll be more than happy. You don't have to give me bank statements or a profit, whatever it is. We can kind of look at it. Because I have a cheat sheet. It's like, can you this? No. Go here. This, no, over here. This, no, over here. And then here are the two that we can use. Great. Go take a look and give me a 1099 or a bank statement, the last couple months bank statement. A lot of people aren't doing that. What do you think when you hear that? Is it something different? Yeah. Good job. Yeah, or people. I mean, it expands your sphere of influence, right? Like, here's the people that I know that I haven't really reached out to because I can't get along. So, but again, it's people who are self-employed. They have different types of income, especially gig workers, other folks that are just, I'm in the business for 2 years. I get a lot of income, but hey, filing a tax returns is a ton of money, and I don't want to spend as much as I can. So I have one was a chiropractor guy. He bought the business 2 years ago, but his income, the tax returns are like not great. But then I can see all the deposits going into the account. Here's what we can do. We don't need the tax return. We don't need anything else. We just need the bank statements coming in. I can show he's been in business for a long time. So yeah, that's good.
What do you say to, like, I had a guy, he had his own, barbecue business, like out of his food truck in Redmond.
Yeah.
And, he was with a lender and a real estate agent up in there and didn't like them. So.
I like you.
So the lady who was doing his taxes all these years or whatever, the old lender had said because he was getting a salary, like they told him to pay yourself a salary. And so is that typically what you
can use that. So that's money that you've collected and paid yourself. So
right.
People do that. I have a corporation. I'm an employee of my corporation. I get a W-2. I can use that as income, right? Then when I file my tax return, I can use the corporate income as well. But sometimes that shows it's a negative or whatever it is, right? So in this case, we would look at a couple different things. We could get the tax prepared to a 1090, a profit loss, right? We could also look at the deposits coming in. If you've got a bunch of deposits coming in, yeah, they're cash, takes cash or it's credit card. We can see that those deposits coming in, and maybe that's something we can do.
And so ultimately, the other person that he went to, they couldn't help. They were like, with you getting an income, so basically, so he's just so frustrated. So now he got a job at Boeing because he's like, I just need to just get a regular job because this. So he's doing that on the side
Yeah.
still, and so he's so.
So if
Does
we're
he
doing
have to
that,
wait?
so yeah, so the deal is that now you have to be 100% full time doing this, right? So you can, so all these want to show that you can't do it part time, right? So I got multiple different self-employed business, but if I'm working at Boeing full time and this is my second time job,
Okay.
so
So
that's
now, does he
traditional.
have to work at Boeing now for 2 years straight?
No, what's he
Or
doing at
can
Boeing?
he,
What's he doing at Boeing?
he got some kind of certificate, like,
All right, so is he hourly guy?
yeah, he's gonna
So
be
he's
out.
hourly, and so here's the deal, if he's hourly, he's there, and the hours aren't fluctuating much,
No.
then, I mean, like, I'm an hourly employee too, right, whatever it is, my income stays the same, right? If I get more in overtime, we can use that too, but as long as the income is stable, then we don't have to wait a long waiting period.
Cause he can, okay.
Because the income's not fluctuating, it's like either
Right.
salary or I make hourly, but I'm working 80 hours
Okay,
every week.
okay. so-
It's fine. But if my income is doing this because my hours change all the time, then I look at it basically a 2-year average.
Okay.
Yeah. So we had another client who started at Boeing a couple months, 2 months ago. I can use the income, he's hourly, but the hours stay the same.
Well, I might-
That's what I'm saying. So it's not like it's not.
Right.
Just create work employment where they get paid for.
No, you can look at, so if I'm self-employed and I go back and I get a salary job for a month, all I need to show is I get paid a salary.
Okay.
If I'm hourly, that's fine. I just need probably a 1 or 2 couple pay stubs to show my hours are variable. They're not variable,
Right.
they're there. But when we have variable income, like, hey, I'm a carpenter, right? And I work for the company. Well, we had snowy days, rainy days, so I'm not working. That's variable income. And that's what they'll look at a 2-year average. So yeah, I mean, I just think it opens up a whole world of stuff that we thought that you can't qualify. And then now it's like, hey, they're so frustrated. Just give me I will talk to anybody you got. And if the rate's decent enough, I'm fine. I get in, right? So that's what these non-QM mortgages are for. And so next month, if we do another class, I have ones that are, I'm an investor and I want to buy a house. Okay. But I don't have a ton of income, right? But the house or the triplex or the fourplex, the payments I get, rent, covers the mortgage payment. If it covers the mortgage payment, I don't need any income from you. I need nothing because it's profitable, right? The entity is profitable. So that's what people do that all the time. So I can buy a $1 million home as an investment triplex. Now I might have to put enough money down to make sure it's profitable, right? So the lower the mortgage payment, then the more profit. So these programs that I'm showing you now are meant for 0 down. I don't have a lot of money down payment. You need probably at least 20% down in some of these programs. The DC, they call them debt service coverage ratio. The debt service is the mortgage payment covers the ratio for getting approved, right?
Okay.
And so the DSCR loans are fine, but you're going to have to put maybe 25, 30, 40% down. See where it is.
Are they able to use any of the state programs? And
For
do you need down payment programs? Are they able?
no, you won't be able to do it on that one.
None of that.
Because all the state programs, the down payment assistance programs are qualified mortgage.
Okay,
They're not doing non-QM.
okay, so they don't flow. Okay.
They don't. So this is meant for someone who can't. I got money for a down because I got my bank statement. Right. But I just don't. Income is killing, right? Or the income piece is killing. So I think that's what I mean. So I have no problem. It helps me out too. These are fairly new. And the more experience I get, the more I know how to do stuff. Different investors that we have, it might work. So, and the cool part about it is that we have an underwriting team. If I get all the information, I can send it to them. Here the bank statements, here the assets, they'll calculate that stuff. Then it comes back, here's what we got. Great. But I mean, because I can't do all this stuff, you know, it's too hard for me to resent stand, but we have a team that will do that for us. So which is cool, right? So they'll look at it and say, here's the income I would use, perfect. Then we have a better idea. Then it's like, hey, we got information, here's the pay, give me your pay stubs, or let's, not pay stubs, but let's pull credit.
If you have a couple that's filing taxes to us, and one is a business owner, another is a W-2 employee,
Mhm.
could you use the business owner
Yeah.
as a bank statement loan, like?
Yeah, because if they're not on there, yeah. If they don't commingle it, right? So he has his own assets over here for business, then yeah, we could use two. So we look at when for approval, we look at credit, income, and asset. So it's how easy to document the CIA. Credit's easy to document. Assets, you either have it or don't. And sometimes the income piece can be difficult. Pay stub, W-2 easy. Self-employed, barbecue, income varies. What can I do? That's the hard part. That's what makes a lender or a mortgage person like myself really good at what we can do is we can figure it out. There's no issue. Because I'm telling you, the ECU and these other banks are not doing what they really want. Again, and that stupid video didn't work. But they went bad. And we all went bad. But like, hey, since you're off that fairway, whatever it is, they're doing their own path. So there's lending.
How much does the rate differ in terms of like a traditional, like?
Like I said, if you're looking at 6 and maybe 6.125, maybe you're looking at 6.5, maybe 6.65. It's not terrible. You know what I mean? So again, it's a program the rate's somewhat inconsequential to a certain degree, like it's not crazy high, but they're getting into a house, they can always refinance later on or whatever it is, but things become more stable to do traditional level finance. But they're getting in, they're getting equity, and they're creating wealth. That's the beauty of what this program does. Any questions about that? Kind of helpful somewhat, just to open your eyes a little bit, other than just down the fairway, man. Well, thank you.
Great. Thank you.
Yeah, you need anything all day. I'll talk maybe briefly about the meeting. Okay. But thanks for showing up. It really means a lot to me. So thank you.
Look at that.
Thanks. Got that. Is there any questions in the chat box? Well, I apologize if for that video. I didn't know how.
That, has dealt with like borrowers, like, so consolidating student loans, is that a good thing when you want to consolidate them? Or it hurts your, that hurts
Well, it hurts the credit. I mean, sometimes if you're consolidating, you get a lower
lower
payment.
payment,
That helps you qualify for a bigger house, for a larger mortgage.
right?
So consolidating it might help. Yeah, I mean, it can.
So people are still, even though they got tax, even though they have like school loans and stuff, whatever.
We still look at their debt. So it's
Still
not
look
like,
at their debt.
we're looking
Yeah.
at their debt. So that to income ratio. So if the debt to income ratio is too high, then do we pay something off? Is there ways to reduce those student loans? That kind of thing to get that ratio lower.
Yeah.
So. Yeah. So thanks for showing up. Yeah, hopefully it's, I mean, I think the program can,
It
you know,
is.
so, I mean, so a lot of folks who just would think that I'm screwed. And then,
Yeah.
like your guy, like,
And that's what he told me. Yeah.
yeah, was he making decent at the bar?
Like, oh, okay, so on, it was like, I still got stuff, it's like 100, but something that the loan officer is like, you're paying yourself, I mean, it was looking like this lady, whoever he went through was just saying, paying himself this money wasn't making him qualify. So, and this was the second loan officer that he went through. And so and I said, well, I can look, but he was in this, I'm gonna go to bowling, I'm gonna get a, you know, so I was like, okay, well, you do what you need to do. And so, but yeah,
Well, I mean, I just see it's frustrating because you're like, hey,
Right.
my butt. I'm not asking for anything crazy. I'm doing my stuff. I'm paying my taxes and everything else. And now you're telling me I
Right.
can't qualify, right?
Yeah.
You know, so it's sort of like a gig worker, Uber driver, whatever it is, right? Like here's the stuff I'm doing on the, here's my hustle I'm working on, and I'm paying my taxes and everything else, but it's not showing up that I can qualify. So there's just a need for these types of loan products because there's so many people that don't fit the box.
right, okay, so he finished in, so he's just starting this month. What should I say? He should wait 6 months and then I'm gonna send him.
Well, yeah, I mean, one is the third unit bowling. And
Yeah.
bowling is probably given an offer letter, right?
Okay.
You get bowling's offer letter that says you were gonna work, expectation 40 hours a week, right?
At this
Great,
time.
here's the expectation of 40 hours a week. Now I've got two pay stubs, you know, a month or two of pay stubs showing your
Okay.
income's not fluctuating. I think that would be okay.
Okay.
And if it's in the same kind of work that he's doing, I mean, like, what's he doing at home?
And
If it was something he's done in the past, right, unless he was a restaurateur the whole time.
no,
That's what I mean. So he's probably got, I mean, I would think it kind of makes sense. You need a 2-year work history. Self-employed, here I did this, I can verify that, or previous, whatever it is.
okay,
But we can do that. Yeah. So I mean, it's just more stability in the income.
exactly, and at least you can kind of tell steer him like, okay, maybe you need to wait till, but at least you can see all
I
the
mean, the thing is,
information.
to start a plan, then
Right.
people get excited about a plan. If there's no plan,
Exactly.
you get frustrated, like, I don't know what's going on, it's stressful. His wife, or whatever, is probably, how can we can't, I don't know, you know, so it's very stressful.
Right, right,
So I think giving people plans and pathways forward is a
Right.
big deal.
okay,
So it creates even more, you know, this should work.
exactly, okay, good, okay,
But
cool.
that's kind of, they look at income